Well, welcome everyone. Welcome to Office Hours with Michael Kitces. As you can see, I'm on the road today. We're coming to you live from the San Antonio airport, where I was speaking earlier for the FPA San Antonio chapter's annual symposium, and did an interesting session actually with Ron Ansana of CNBC World, talking about technology trends in the advisor space, and this whole question of whether robo-advisors or technology more generally is more threat or more opportunity, and basically with all this discussion that robots are going to take jobs, what's the risk of the jobs outlook in the financial advisor space given all the technology that's coming in? Because the early fear, or at least debate, was that basically robo-advisors were going to replace advisors. At least that's what the robo-advisors came to market with, saying we're here to replace advisors and do it cheaper. And now that we're a couple years in with, frankly, very limited growth of robo-advisors, I don't mean to knock the assets that they built with companies like Wealthfront and Betterment at $10 to $15 billion, but when the total U.S. investable market space is upwards of $35 to $40 trillion, like we're talking about something on the order of 0.06% market share of investable assets, which means I think we're past the question of whether robo-advisors are going to replace human advisors in the mainstream. They're not. But it doesn't mean that the rise of technology won't reshape the nature of advisory firms, what it looks like, what we do, and where the jobs are. And so I wanted to talk about that theme today, because while our jobs as financial advisors I don't think are necessarily threatened by technology, there are other jobs in advisory firms that I think are actually very threatened by the waves of technology that are coming through. Because at a very high level, we can break jobs in advisory firms into two categories: front office jobs and back office jobs. Front office jobs in advisory firms are the client-facing jobs. So for the most part, that's us as financial advisors who sit across from clients, as well as maybe some folks that, like your front office receptionist who greets clients when they come in. That's a client-facing role. Back office jobs, by contrast, are not the front office ones, not client-facing. So this is most of the operations and administrative jobs in the firm. Portfolio training, account openings and transfers, insurance annuity applications, scheduling meetings, like jobs that handle a lot of paperwork stuff, or maybe now like e-signed digital paperwork stuff, and are hands-on to make sure that all those important tasks that have to happen over and over again in a firm actually happen the way that they need to. It's crucial for just delivering the services that we say we're going to deliver. Now, as some people add in a third category as well, called the middle office, and the middle office are basically the jobs that hold the firm together as a business. So it's the other executive and management jobs in the firm, maybe it's financial planning or investment research jobs, compliance and oversight jobs, and so forth. Other types of higher level jobs with higher level responsibilities, not necessarily about doing client work or supporting clients or seeing clients, but just the rest of the stuff that keeps the business together as a business. But the key point to understand is that there's a range of different advisory firm jobs, from the front office client-facing stuff to the back office administrative and operations stuff, and the middle office jobs that hold it all together. And the reason this matters is that the real threat of robo-advisors, or technology more generally, is not the advisor jobs, which are the front office client-facing jobs. The threat of technology is the back office, more administrative jobs. Because while the back office jobs are absolutely crucial, again, they're, I would argue, doing a lot of the actual getting stuff done parts repeatedly, day after day, week after week, client by client, that has to get done. But it's the very repetitive tasks that are the ones that are most prone to getting replaced by technology in the first place. For instance, take the process of actually implementing a client's portfolio. So when I started my career, my second job was as a paraplanner and operations associate at a firm. Like, I did this hands-on. And allocating client portfolios back then was a very labor-intensive process. So first, we'd look at just what the current positions were in the client's accounts, and we had to pull their statements to do that, because we didn't have good software to do downloads and take this in real time, and every client had different investments because we weren't very standardized back then. So we had to literally pull out clients' like physical statements at the time, duplicate copies that had been mailed to our office that were held in the client file, just to figure out what they had. Then we'd manually type up in a templated spreadsheet to show what their current asset allocation would be. That was the output that we gave them. Then we'd pull Morningstar Principia Pro reports, which was the predecessor to the current Morningstar research platform, to analyze each fund and see how it was performing. Then if we found any that didn't look good, then we'd have to do some research, find an alternative to fit that particular part of the asset allocation pie. Then we'd have to figure out if there was like a rebalancing trade or a change, exactly what the trade was going to be, manually calculate any capital gains implications, craft some recommendation for the client, so that we could take it into the meeting. And then if the client approved in the meeting, then we had to log into the early version of what was a custodian's website to submit the trade order, typing in one ticker symbol at a time with the amount, the dollar amount or the shares. Then we have to come back the next day when the trade settled and do the purchase, because we didn't have an easy way to see if the mutual fund was going to be up and down during the day. So we didn't know how much of the replacement order to buy until the prior sale occurred. So we'd have to do the sale, wait for the cash to settle, have the cash come in, then decide how many shares of the new stock we were going to buy or the new mutual fund amount dollar that we were going to purchase. It was a multi-day process, completely manual, switching back and forth between spreadsheets, trading platform, Morningstar research tools, took 3 days. And so each advisor with a good-sized client base had their own full-time assistant just to handle like basic rebalancing that had to happen like this, each client review meeting all year long. And now with modern rebalancing software, you can create standardized models, apply them as a template to each client, have the software automatically monitor, track every client, tell you who needs to be rebalanced, what the capital gains implications are, automatically work up the trade order, write dollar amounts, write share amounts, write accounts. One trader can hit the button, do this for 1,000 clients at once. It takes an hour or two. And most of the hour or two is probably just to verify the software queued up the trades properly as like a compliance review, not because it actually takes the time even for the software to kerchunk that long. And what that means is for sizable advisory firms, the clients of a dozen advisors might have needed a dozen staff members to do the trading in the past, and now it's one person and a piece of software. Maybe a second person to back up the first in case the first one gets hit by a bus. But I viewed it another way, like for a large advisory firm, the advent of rebalancing software probably destroyed thousands of jobs for traders and advisor assistants that just aren't needed because of the efficiencies of the technology now. And the more that technology marches on, the more that I think you'll see this happening. Robo onboarding tools, fewer staff members to do account openings and transfers. Online scheduling apps, no longer need an assistant to schedule all those client appointments. Because in the end, I don't think clients really want to call and email someone if it's something that they can really just do directly with technology with the same amount of time and effort. Like if I can just click a meeting off your calendar and the time it takes to email back and forth to find a time on your calendar, it's easy to just not contact you and use a scheduling app. And the more that we adopt technology like that, the more these other jobs start to disappear, because clients don't want to deal with it. We as advisors don't want to deal with it. That's why we hire staff and delegate those tasks down. It's not our value proposition. I'd argue in the end, as this technology comes in, it actually elevates the value of the advisor, because now clients don't have to contact us for all that administrative stuff. They can just use technology to help them do it, and they call us as the advisor for like the real advisor stuff, the advice stuff that they need. But in the process, back office jobs start to go away. Again, from the financial advisor perspective, I think this is good news. It means we're more efficient. It means we can spend more time actually focusing on our interactions with clients as administratives tasks kind of vanish into the technology. We get more profitable firms, and we can spend more dollars on more front office staff to have more time in front of clients, to have more people giving client touches. Like, all of it's very positive from the advisor's perspective and the advisory firm's perspective. However, if you are an employee in an advisory firm, if you're in that trader or sales assistant or administrative position, technology is not good for your long-term prospects. I don't think literally a robot is going to come to do your job, like there'll be a anthropomorphized version of a robot sitting in your chair doing your job. The technology is just going to increasingly automate tasks that you do today and make it less necessary to have staff to do it. Now, to be fair, in a growing advisory firm, I actually don't think this means a lot of people in the current positions are going to lose their jobs. All it means is as the firm grows, they're not going to need to hire more people. And instead, the people doing those administrative tasks now will do it for more and more clients without hiring more people, because the technology will make them more efficient. And maybe some job duties get rejiggered or job descriptions get shifted and rewritten a little over time. But for firms that are not growing, or for those of you who maybe are more growth-minded and aspirationally, personally about your business opportunities and you want to move up, you need a plan for what happens as the technology gets better and better, because it is going to start to impact back-office jobs. Again, I think it's actually underway already. It will only impact more as the years go by from here, which really means there are two tracks. Option one is to try to move up on the administrative side of the organization. If the technology makes repetitive tasks easier, do the non-repetitive tasks, the higher level investment research, management jobs, human resources, executive leadership. Like, those middle office jobs remain a path forward for more income and more responsibility, with the caveat that not everyone is necessarily going to have the room to move up, because there are usually fewer middle office jobs than back office jobs, right? One manager, 6 direct reports who are admin staff. Not all 6 people can get that one manager job. Only one person's moving up. Option 2 is to try to move into the front office, into a client-facing role, or and going down the road to becoming an advisor, which means eventually pursuing CFP marks yourself, or at least starting down the road with something like College for Financial Planning, as what they call their Registered Paraplanner designation. They actually recently rebranded it. It's now Financial Paraplanner Qualified Professional, or FPQP, which lets you learn the skills you need to be a paraplanner and start working as an associate under another advisor and begin taking that pathway towards becoming a financial planner. And then perhaps over time you can get your CFP marks, learn the technical skills to become a planner, and the relationship skills and the business development skills as you move up your career track. Now, again, the caveat to all of this is that if you want opportunities to move up, you have to be at a firm that's willing to create these opportunities, has a career track, and invest into its people. And that's actually why I'm such a strong advocate that for anyone who wants to grow their own career, one of the key questions to ask is whether your firm is growing. Because if the firm is growing, future opportunities will emerge. If the firm isn't growing, it's hard to move up. Better technology lets them save on costs, but that means your salary as a staff member is their cost savings. And if new clients aren't coming aboard, there's really nothing to move up towards. But the bottom line is just to recognize that the rise of technology isn't a threat to financial advisors, because the technology just isn't doing what advisors do. Robo-advisors really never did. They were all about operational efficiency and replacing a lot of back office administrative tasks that advisors themselves, I would argue, shouldn't be doing anyways. They should be tasks that are delegated and eventually tasks that are automated. And to the extent we have back office staff, we can do that now by delegating. Eventually the technology will do it cheaper and more efficiently, which is why I don't see the impact of technology as negative for advisors, but a negative for the back office jobs. So if that's you, have a plan to move up to the middle office, to the front office, but you need a plan to reinvest in yourself and grow and move forward. If you're a firm owner, have a plan to reinvest in your people so that they can stay with you and move forward as your staffing needs change, because the technology will change them as it takes a lot of the tasks you do today and increasingly automates them. So I hope that's helpful. It's a little bit of food for thought. This is Office Hours with Michael Kitces. We're normally 1 p.m. East Coast time on Tuesdays, but obviously traveling this week, hanging out at the San Antonio airport. So thank you for joining us today, a little bit off schedule, but hope it's been helpful. Have a great day.